to combat the economic impact of this, you might have heard that the Federal Reserve did something it hasn't done in the better part of a decade, cut interest rates between meetings, something that, again, has not happened since 2008. The half-point cut, which brings us to a range on the Fed funds of the overnight bank lending rate of between 1%, 1.25%, was meant to sort of boost and calm the markets. Just the opposite effect. At our worst levels, we were down better than 650 points, now slicing that to about 195-point loss. But these are, as they say, fast market conditions. Agora financial market strategist Alan Nuckman from the CME. Alan, are you surprised at the response of that half-point cut is given, or did it reignite fears? The Fed must know something we don't.
Not necessarily. You asked who knew, and I'll tell you who knew. The market knew. There was a 100% chance there would be a half-point cut, according to the CME market tool, coming into that by that March meeting. So we didn't know it was going to be today, but we knew by that March meeting that was going to happen. So the markets had already kind of priced it in. But if we look further out, there's more cuts in the pipeline. Looking at that analysis, there's a 50% chance of a quarter-point cut by April. There's a 25% chance of another quarter-point cut by July. And if you want to get crazy, you go all the way to December. There's a 5% chance that will bring rates all the way down to zero.
All right, and then what if it doesn't have the desired effect?
Well, that's the question that traders are asking, is what impact does it have? I think it's mainly psychological, but there are some people that question, and I myself am wondering, I don't believe that there's any independence left in the Fed. That's not my business. My business is making money, so I don't care how what's causing the markets to move. I want to take advantage of the market movement. So does that leave any more bullets, for the Fed if there is a continued downturn or this escalates? That's the question you have to ask yourself. But more importantly, I'm a price guy. And look at the way the market responded yesterday, and we stabilized on Friday, had mixed markets. We were up yesterday. If we can build on it, get above the halfway point. Right now, the S&P is down about 8% off its highs, and it's 8% off the Friday lows. So we're getting close to that midpoint, and that could be very important to build on.
Though, if you think about it, Alan, cutting rates, even if you cut it down to zero, doesn't put more cash in the banking system. And if my memories of the financial crisis were right, it was the freeze on that available cash. People who had to make margin calls all of a sudden had to sell their stock. There was no cash to compensate for that. That spiraled out of control. So the next move, the Fed does have other arrows in its quiver besides cuts. I get that. It can, flood the banking system with a lot of money and all that. Would that be the next step? Because that would be doing stuff that it did to address the financial crisis, and an act like that would maybe potentially panic the markets, wouldn't it?
Look at the hundreds of millions of dollars they've been adding to the repo market every day to stabilize. So that's another lever of stimulus. So the question is, how many...
What if that's not working? In other words, what if that stimulus effort to provide more cash and to provide in the repo market isn't doing the trick?
That's why I don't work for the Fed, because I wouldn't have put myself in this position where you are limited in your options. But what I will say is that what this has done is it's continuing to lower rates. That makes stocks that much more attractive. If rates are down here 1% and going lower, and look at the yield in the 10-year note is down at 1%, the stock market yield, the S&P 500 yield is greater than that, plus PE ratios have come down on stocks. So stocks are cheap in relative terms. They're going to give a better return than you can get in Treasury. So it's back to that choice. And again, there's not much of a choice. If rates continue to go down, that makes stocks look that much better. For money flow, money has to go somewhere, and I think the stock market's still going to be the place. All
right, Alan, always good talking to you. Thank you very, very much. And as Alan indicated here, that is the thought, that people will look at the paltry yields you're seeing on a 10-year note now slipping to around the 1% level, the lowest it's ever been, and say, you know what, I can do better just on a higher yielding stock. And virtually all the ones that provide dividends are offering you a higher yield than the 1% you're getting on that 10-year note. In the market now, it's been sort of like waiting for Godot for it to happen. We saw a lot of it actually, in yesterday's big run-up, but we're not seeing it to the degree that maybe a lot of folks had hoped with this half-point cut. Charlie Gasparino here to sort of digest all of that. What do you think, Charlie?
Well, a couple things on our reporting, just so put it in context. On Thursday, we were actually the first report that the market was basically talking about an emergency rate cut, that it would come very soon. So anybody...
And that it wouldn't be waiting till mid-March to do
and, it's funny, like, only on the New York Stock Exchange where traders might be surprised at this thing, because your last guest said it right. I mean, most sophisticated traders knew Powell was going to do something, plus Trump.
Did they expect it today?
Yeah, today or yesterday.